Well, good afternoon, everybody. My name is Lee Schwartz, and I'm the Director of Business Development here at SVA. I'd like to welcome you to the first webinar of 2025, at least our first webinar. Stay ahead of the curve, tax and business updates you can't afford to miss. Before we get started, I just want to take a quick moment and say a few words about SVA. Our vision is to remain independent, and our goal is to continue working with the same clients we have since 1974. Closely held businesses, family-owned businesses, nonprofits, and high net worth individuals. And our mindset over these last now 50 years is that when you're a business owner or shareholder, your business is more than just a job. It's going to affect you personally. So it's important that your advisors are not just about compliance, but that they're working collaboratively with you in a consultative way, and that's our goal. This webinar and others like it are just one small way in which we do that. As far as this webinar goes, we will save time at the end for Q&A. Please send in any questions you have as we go, but we'll wait until the end to answer them. And let me introduce our speakers. We've got 4 of our principals lined up to cover a bunch of different topics. Eric Trost will give an overview of tax updates on the horizon and some expiring provisions. Rick Colliff will cover estate tax changes. Dan Glomsky will discuss business climate shifts, and Nancy Melberg will talk about planning for business and financial uncertainty. So without further ado, Eric, I'm going to let you get it started.
Very good. Thank you, Lee, for the introduction. As Lee stated, all the things we're going to cover, we've got an hour of excitement ahead here. So stay tuned. Make sure you have your coffee cup nearby and you can pay attention because we're going to kick off with tax updates on the horizon. So one of the things that happened with the first Trump administration was the passing of the Tax Cuts and Jobs Act. So Trump was elected the first go around in 2016, and in 2017, Trump and the Republican Congress and Senate passed the Tax Cuts and Jobs Act. A lot of provisions within that act, especially as applying to individuals, were set to expire, and we're coming on that expiration date. A lot of them were set to expire at the end of 2025, so that's this year. And part of this last election, there was concerns about, well, what's going to happen with all those expiring tax cuts? Now that Trump's been elected and has a, albeit somewhat slim, margin within the House and the Senate, we do have some clarity, at least directionally, on how some of these expiring provisions are going to be treated going forward. And so what we're going to talk about today is what's expiring and some possible outcomes for these expiring provisions. Now, having said that, you'll see that column that says possible outcome. That's because these are possible outcomes. These are not set in stone yet, and they do tend to change through either negotiation or through what used to be called tweets. And so I think what you're going to see is a lot of back and forth on this. And when I say this is possible outcome, know that there are other things that could happen. And it could happen as remote possibility, things like Trump has said, hey, we shouldn't have income taxes and everything should be done through tariffs. That's a real outside remote possibility. And so I'm not going to give it any more time than I just did. But know that these possible outcomes, I'll say, are likely, but not the only outcomes. So we'll start with marginal tax rates, which had a top tax rate of 39.6% prior to the Trump tax cuts in 17, went down to 37. Those are expiring at the end of 2025. They go back to 39.5 or 39.6. It's likely they're going to stay the same. I do not think that there's going to be a raise in tax rates at the end of 2025. It's likely that they're going to extend these same top tax rates. And that goes the same for the line below on the standard deduction, which moved up to $29,000 for married, filing joint. These are double what they used to be. So that started in 17. It's expiring in 25, but it is likely that's going to hit a tax bill and be extended out or made permanent. Next on this list is a child tax credit. This child tax credit, which is up to $2,000 now, it was 1,000 prior to the Tax Cuts and Jobs Act in 17. So it's scheduled to go back to 1,000. This one is really up in the air. There's a contingent, I think a bipartisan contingent that wants to see this extended for at least $2,000 and actually even more. What happened in late fall of 2024 is some of these tax provisions were addressed. This never got passed, but there was a bill called HR 7024 that made it through the House and to the Senate where it stalled and then it died. But that bill still exists out there as something that could be revived. And within that HR 7024 was even more expansion of the child tax credits. So there is some political will for that, but it's hard to say where that's going to go. So I left that open with a question mark, just have not seen it addressed yet. The next provision is the state and local tax deduction limitation. That currently sits at $10,000. Prior to the Tax Cuts and Jobs Act in 17, you could deduct as much taxes as you paid, and that included your real estate taxes, your state income taxes, and other types of local taxes that could be assessed. Whatever you paid, you'd get a tax deduction for it. In 2017, through the Tax Cuts and Jobs Act, there was a cap on that deduction of $10,000. It didn't matter if you paid $10,001 or $10 million in taxes, your deduction was limited to $10,000. This has been a point of consternation ever since it passed, and there's been bills that have been floated but never passed about increasing that cap limitation. And the persons that really want this increased are the ones that tend to be in high tax states. That would be like California, New York. Believe it or not, Wisconsin is not quite a high tax state. It's kind of a medium to high tax state. There are higher tax states. And those senators and congressmen from those states, California, New York, New Jersey, Connecticut, have all been pushing for higher state tax deductions. So it's likely that I think that this is going to increase. There's been some floating that, hey, we should just repeal the SALT altogether. So no cap again to go back where we were before, pre-2017. But at least I think if that doesn't happen and it gets repealed, I think it could be doubled. So it goes up to 20,000 instead of 10,000. Moving on to a couple other expiring tax provisions for individuals is the alternative minimum tax, which really has not had a big effect on individuals since the 2017 Tax Cuts and Jobs Act. That's likely going to be tied to what happens with that previous SALT cap limitation. Those two are typically tied together. And so when you see one go one way, this alternative minimum tax will probably follow with some provisions if, say, the SALT cap is repealed. And the mortgage interest limitation, which right now is 750,000 of debt you can deduct mortgage interest for. There's been some thought of reducing that to 500,000 or keeping it the same. So I think there's still going to be some cap on that mortgage interest limit, which, by the way, it used to be $1 million before the Tax Cuts and Jobs Act. It was reduced in 2017 to 750,000. So it looks like that's likely to stay or even be reduced. There's also been some expiring provisions that are coming up for business taxes. The biggest one being the qualified business income deduction, which is a 20% deduction for income that flows through from either a partnership or an S corporation, which are the type of businesses that are taxed to the individual who owns them rather than having a tax at the business itself. That income is taxed at a reduced rate, 20% reduced rate from top tax rates. So owning a business means that your business income is taxed at a maximum of 30% instead of that top tax rate you saw of 37% on the individual slide earlier. That top tax rate then, by being reduced by 20%, goes across the board for all business income. That expires at the end of 2025. Trump has already indicated that this is a provision he likes and is likely to be extended for business owners. And the final tax break that's phasing out right now is bonus depreciation, which was 100,000 or what 100,000 was 100% back in 2017. That provision has slowly faded away. So it's went from 80 to 60 to this current year in 2024 is 40%. So that means when you buy a new asset, you can write off 40% of it right away. Likely that's going to go back to 100%. That's what the current proposals are. Next, there's some possible new provisions that have been talked about that will be interesting if they get passed and how they get implemented. One is to eliminate tax on tips. This is something both Trump and Kamala Harris talked about, is we're going to eliminate tax on tips. And how that would work, uncertain right now, but certainly restaurant workers will be watching this closely. Also eliminate tax on overtime. So eliminate all income taxes and withholding taxes on overtime. That would be the first time a provision like that has ever been passed. So it'd be interesting to see how that gets implemented. They also talked about perhaps introducing again the auto loan interest deduction. Auto loan interest hasn't been deductible since 1986. So this is bringing up an old provision that individuals used to be able to deduct their auto loan interest. That's pre-86. So that's bringing that back. Again, these are possible new provisions that have been floated. There's a couple new provisions that have been floated for business as well. And those are lowering the corporate income tax rate, which currently sits at 21%, lowering it to 15%, or at least lowering it to 15% for manufacturing companies. Perhaps instead of 15%, they'll take 21 and lower it to 20. So that's another provision that's floated. The reason that's important is running a small business, a lot of them tend to run as what's called flow-through entities, which are S corporations and LLCs. The lower the corporate tax rate gets, the more interesting it is to see should your business run as a C corporation or not. So that's going to be something to watch carefully, because if that corporate rate does lower to say 15%, it would be time to reevaluate how you run your business and if there's a advantage to changing your current business form from what it is as a flow through to a C corporation. Couple other business provisions that have been floated is to get R&D expensing as 100% deductible again, instead of this 5-year spread that's out there now, and to get interest expense deducting higher than the current ceiling limitations on that. Moving on to some potential tax raises for individuals that have been floated. Currently, there's deductions for student interest. There's credits for green energy investments in both autos and in energy efficient for your home. There's some college subsidies out there that come through the lifetime learning credit and the American Opportunity Credit. Those could all be on the table as potential eliminations to help pay for some of the tax cuts that could be coming up. But again, those are floated as potential. So you might see this then come up in the negotiation for the final tax bill. There's a couple other executive orders that have been out there. If you've been following, Trump's put out, I don't know, it's probably more than 100 executive orders now. He's you see him sometimes at night and he's riffing away as he's signing all these executive orders and, you know, talking the way Trump does. It's very energetic, though, is the one word to describe it, on how he's putting out all these orders. And a couple of the orders I want to point out that might affect tax law. One is the Department of Government Efficiency. So that was created through an executive order. Probably familiar with Elon Musk, and that he's certainly part of that, if not heading it. And one of the things that the Department of Government Efficiency is going to look at is regulations, and if there are too many of those, and should they be eliminated. A lot of tax law comes through regulations. So Congress writes the code, but effectively the IRS issues the regulations that help administer that code. And at any given time, there's regulations floating in process that could get passed or could get through the IRS that don't need congressional approval. That's what this Department of Government Efficiency is looking at. I don't know if it's pronounced Doge or doggy? I haven't figured that out yet because I've only read it. So maybe our viewers can chime in on that. Second executive order talked about a hiring freeze at the federal government. This includes the IRS agents. There has been a couple years ago under Biden, a law passed about expanding the IRS funding $80 billion to hire a bunch of new agents. 80,000 agents is what they wanted. Haven't really gotten that started yet. Well, this hiring freeze, this would affect that plan as well. There wouldn't be IRS agents hired under this hiring freeze, much less any government worker. It's temporary until they can figure out who they really want to hire or not. But as of right now, that hiring freeze is out there, as well as the regulation freeze. That regulation freeze does affect the IRS and their ability to, issue what they would consider clarification statements regarding the congressional law. So moving on, we're going to turn to Rick Koloff, and he's going to talk a little bit of estate tax and what's coming up for that.
Thanks, Eric. So turning to the other end of the Internal Revenue Code, that for estate gift and generation skipping tax, I just want to lay out some basics. First of all, in 2017, as Eric pointed out, the Tax Cuts and Jobs Act was passed, set to expire at the end of 25. And so for the last 8 years, estate practitioners have been preaching from the rooftop. You got 8 years to do some estate planning. You got 7 years to do some estate planning, and so forth and so on. Well, as of today, I think we have like 337 days. And that means why? So to understand why, the lifetime exemption, which is unified for gift and estate taxes, was $5 million plus inflation. And then in 17, think of the original amount, the original $5 million, say, as a cupcake. And then in 2017, another layer of $5 million plus inflation was added. Think of that as the frosting. And so we've been going along with that inflation. In 2025, a single person can give or die with 13.99. I don't know why it's not 14. It's $13.99 million of stuff before they have to worry about a gift or estate tax. And that's a lot. But with the sunset, about half of that is going to go away. And in order to get at the amount that's to go away, that bonus amount, that frosting, you have to eat the underlying cupcake first. You have to eat the base layer first before you can get into the frosting. So it becomes very important in how we structure our estate planning prior to any sunset. Well, some of you might say, well, we just had this recent election. We've got a Republican president, a Republican Congress. Seems like this whole sunset is probably something we shouldn't worry too much about. Well, let's talk a little bit about why that's a bit of shaky ground thinking. So there is this uncertainty, right? And I think what we need to think about is what is the political climate and why things are so uncertain. First off, even if we were to try and avoid a sunset, we actually need legislation. The current law is the sunset will happen. In 17, that tax legislation didn't get passed till late in the year, like just 22nd of December. So even if we want to look for clarity by the end of this year, it's likely we won't see any anytime soon. While we have a majority in both houses, we still have yet to see any types of bills to be proposed. In order to get the sunset eliminated, probably we need to have a budget bill first. Sometimes that's introduced in February, sometimes introduced in March. Why do we need that to happen? Because without a budget, we can't introduce a reconciliation bill. And why is a reconciliation bill important? Reconciliation bill, or that tweaking type bill that Eric mentioned, is important because if Congress is not voting on a reconciliation bill, they have filibuster rights. In the House, a simple majority can override a filibuster. In the Senate, it requires a 60-vote majority to override a filibuster, and there isn't that level of majority currently. So a reconciliation bill could be introduced for the 24 fiscal budget. The federal government is on a fiscal year, but it's unlikely, in my opinion, that any tax provisions will be included because Trump has already indicated that probably immigration is something that'll be on the plate first. So if we look for a second reconciliation bill this year, it's likely to be part of the 25 fiscal budget process. Another thing that causes uncertainty is the Byrd rule. The Byrd rule allows for the Senate procedure that any senator can object to or pull out and eliminate items that don't have to do with the budget. In addition, it requires that things that reduce taxes have to be eliminated within 10 years. That's kind of why we have the sunset now. So one of the other thinkings is that even if we do get a provision in a reconciliation bill to avoid the sunset, it may not apply for 10, it may not apply for 8 years, it may only apply for 4 years. We also have to deal with not only that razor thin margin that I talked about, but certain deficit hawk Republicans who may not be just sitting there waiting to approve everything that comes forward by the Republican Party. They're worried that we currently have a $36 trillion deficit and that avoiding the sunset of the Tax Cuts and Jobs Act could add another $5.8 trillion to that deficit. So my crystal ball says there could be even a 15% chance that Republicans just don't even get it together to avoid the sunset. That still leaves a pretty good likelihood that we will see some avoidance of many of the sunset provisions, including likely the estate gift and generation skipping tax. Okay, so what can we do now that we understand the lifetime exemption, its importance, and the uncertainty we have? We can start thinking about tranches of typical taxpayers. We can think about certain taxpayers, let's call them ultra high net worth. Ultra high net worth could be looked at as double the exemption amount of assets for a married couple. So that's roughly 13.99 times 2, $28 million in stuff. Let's call it $30 million. These folks may, according to what I've discussed in terms of uncertainty and lack of uncertainty, may think of things not as a fire. It's not a big time sensitivity. However, they still need to be doing all the estate planning techniques that we've been talking about since the Tax Cuts and Jobs Act, utilizing both of their exemptions, looking at grantor trusts to include the ability to continue to pay tax on those trusts. The ability to pay tax on those trusts creates additional ways to move assets outside of your estate that are not deemed to be gifts. In addition, the ability to put in swapping provisions in these grantor trusts to step up basis and assets at a later point. Because when we move assets to trusts, like grantor trusts that are irrevocable, those trusts take carryover basis from us. And for folks that pass, that own assets outside of a trust, there's a step up in basis at date of death. So to have the ability not to lose that step up in basis and include a swapping provision is very important as we look to these types of trusts and implementing them. Then there's the folks that are below that $30 million and perhaps above a single exemption amount. Let's call them the high net worth. While they need to be on guard as well, there probably is more of a fire underneath what they should be doing. And for those folks that don't think that the sunset will happen, I still think you want to be doing some things that will put you in place in a good spot so that if it does happen, you're ready to go. So you may want to work with your estate planning attorneys and have these trusts set up. Maybe they're not funded, but at least consider setting them up, paying the fees to get them drafted so that if, as I say, we don't have the extension of the lifetime exemption where it is today, you're able to work quickly at the end of the year to get some things done. You probably also want to at least consider using one of your, if you're a married couple, using one of your lifetime exemptions. And for preparers, that means don't just use the default joint or gift splitting. We don't really use gift splitting in Wisconsin, we use joint gifting. Because if you're trying to use one person's lifetime exemption, we want to focus on one spouse rather than both at the same time. So a couple pro tips for those in this category that are a little queasy about giving assets away. Let's think about what we might be able to do to build in some flexibility. You might put in a disclaimer provision. So let's say your beneficiaries are your children and you set up these trusts, you fund the assets, but late in the year, we find out in actually 26 that the sunset isn't going to quite happen. And you feel bad about putting those assets in the trust. By using a disclaimer provision, the beneficiaries, assuming they're friendly beneficiaries, are going to be able to disclaim those gifts, essentially unwind what was done, and that is not treated as a gift back from the beneficiaries. So that flexibility is something to build in. There is something called rescission that might be built in. However, you have to set these types of trusts up in a legal friendly state that has these types of allowances. Then you've got those folks below a single exemption amount. Let's call them the mass affluent. And I think here we want these people to focus on what they should be doing. These are typically folks that are still accumulating wealth. They may have minor children, so you want to make sure that you at least have estate documents in place that outline, who are going to be your guardians for these minor children, who are going to be your executor or personal representative or trustees in the case of people that have joint revocable trusts in Wisconsin. That's important to set your fiduciaries up, because if you don't, the court will. And I think most people would rather pick and choose rather than have the court pick and choose. Additionally, having financial powers of attorney, medical powers of attorney, wills and trusts that help avoid probate are the things that you need to have in place, at least as a base set of documents. So those are things you can be doing. Look, for the mass affluent, if they're still accumulating wealth, it's likely they're accumulating it at rates greater than inflation anyway. So it may be not in the too distant future that your assets will actually outpace and be above that lifetime exemption amount or double that amount for a married couple, whatever it may be. So getting things started is a good way to start your estate planning for taxes, should that ever become a paradigm for you. Okay, so what else? Universally, I think we want to build in flexibility into our documents. We want to coordinate as well with all our advisors. So folks that are your CPAs, folks that are your attorneys, insurance people, and your investment advisors. We don't want to ever put people in a position where they have given away too much too soon, and in the end could potentially outlive their assets or not enjoy the level of assets that they've put in play. So that type of planning, it needs to start at the very beginning. And I encourage everyone to proceed accordingly. In wrapping up, I would tell you, understand what the current exemptions are, watch the news, watch the webinars, and whatever ways you have to keep and stay informed, and then consult with your planning professionals. And I hope this has been a good session for you in terms of estate gift and generation skipping tax. And I'll hand it over to Dan at this point.
Excellent. Thank you, Rick. And I think that's, obviously the life lesson on estate planning is it takes some time to make decisions and sort things through. So the sooner you can get at that, I think you'll benefit by having a more thoughtful plan and probably a better strategy. So what I want to switch to is some of the business climate shifts that I guess we want business owners and individuals within businesses to kind of be aware of, because I think it's time to maybe start thinking about some uncertainties that could affect your business, in which case you probably want to do some planning, or at least put some plan Bs in place, or have another sheet of paper on the side of a plan where you might go in the event these things come to fruition. So the first thing I want to talk about is something that we kind of communicated quite a bit on, and that is this Corporate Transparency Act, or beneficial owner interest reporting. And this is something that was put in place in 2021. Its intent is to collect information for the government to be able to, look for money laundering, terrorist activities, financial activities, tax evasion, that type of thing. So the government obviously has intent to grab information that help them enforce these types of things, and this was part of that. The problem is when we go to the businesses that need to report this, we are looking for businesses that have fewer than 20 employees or have 5 million or less in sales. So that means if I have 21 employees but I only have 4.9 million in sales, technically I'm supposed to register with this beneficial owner reporting. And yeah, your organization has to be physically located in the US. So those are the requirements for what entities should be worrying about whether they have filed this or not. And the reason I say whether they have filed this or not is because the technical requirement due date was January 1st of 2025. And if you're a new entity that formed in 2024, you were supposed to register your entity within 60 days and so forth. So this registration is something that's in place currently, but the enforcement is probably the bigger issue. Can we go to the next slide? So what we want to get to on the beneficial owner reporting is it's not a complex reporting process. Where I believe the issue and the client reluctancy on my side is that beneficial owner information. So yes, we're providing the government with the full name and the address and the jurisdiction and tax ID. Maybe the government already has that information in some respects. They're really interested in this beneficial owner. And the beneficial owner is anybody that has more than 20% ownership in the company, whether, who has the control of the finances, who's making the business decision. There's a variety of people that are beneficial owners, and the rules require you to identify all those beneficial owners, and then you need to share their name, their birth dates, their addresses, and then you got to produce a driver's license or a passport, right? Very intrusive from providing information to the government, at least to the FinCEN organization. So where do you stand today? So there's a couple federal courts have issued injunctions. Certainly people have filed lawsuits against the government saying, hey, this is unconstitutional. We shouldn't have to provide this information. So what they've done is these federal courts have issued injunctions, and then they kicked the ball up to the Supreme Court and said, hey, Can you remove these injunctions for us? And ironically, the Supreme Court has removed the injunctions, but then other states or other federal courts have issued more injunctions. So this thing just continues to be a bone of contention as far as whether we can actually get the enforcement. So currently, the enforcement of this reporting is on hold. And just to give you some insight as far as the constitutional challenges they're looking at is the unreasonable search and seizure, meaning that, hey, we shouldn't have to provide this, private information to the government. And there's, such a short notice and that type of thing. The Supreme Court came back and said, well, the short notice piece is not relevant. You've had plenty of time to provide that. So they didn't feel like the search and seizure was so much an issue. And at least for the court case that it had to lift the injunction on, had no problem doing that. But then there's also the 10th Amendment, which is imposing a federal regulation in the area traditionally managed by state law. So basically collecting information that is really the state, everybody's registered in a particular state. The state really should have the right to collect that information, not the federal government, and so forth. So these are some of the challenges that they're looking at. Moral of the story is this stuff is currently on hold, the enforcement of it. And then we can go back as far as next slide to, I guess, our recommendations. To the extent you're not aware of what needs to be recorded, who the beneficial owners are, feel free to get in touch with us. We can help you kind of work through that. You can also work with your attorneys to help you identify those as well. There's a voluntary registration, so you can still register your entities, and that is certainly okay. And you can hold off until the court system kind of works through the compliance or the constitutionality of this thing. I do ultimately think that at some point in time, this is going to become a requirement and that this information is going to have to be provided. It just may be time before that requirement exists, and maybe the type of information gets toned down to some degree or not. My biggest editorialization on this is that I think the people that comply with this are the people that are not breaking the law or hiding money and that type of thing. And the people that are doing that are the ones that are probably not going to follow the rules anyway. So I don't know how much the government actually gains by doing this, but nonetheless, we would say that it's an opportunity the government's trying to seize on and collect some more information. So that's where we are in the corporate transparency reporting. The other two things I want to kind of quickly head on is the tariffs, right? So Eric mentioned the executive orders and Donald Trump, kind of putting things in place that start to affect the trade. And although he hasn't signed any executive orders on the tariffs, he did come out and say that he would assess a tariff on Mexico and Canada to kind of leverage some negotiation as far as immigration and those types of things. So he's really, in my opinion, looking at the tariffs as an opportunity to leverage something else, right? And although there's a financial benefit and maybe an equalization of competition or those types of things, but I think the bigger play here is the tariffs are really his negotiation toy, and he's going to play with that around all the countries, right? So I don't think, because you're our neighbor, right, Canada or Mexico, that's not going to give you the immunity to not have a tariff potentially imposed. Obviously, China's a big target for him. I think the 60% tariff would be kind of punitive for the country and create an inflation issue that I don't think he really is looking for. So I do think maybe we see a tariff additional increase with China, but I think the 60% is pretty high. And then other countries, right? India, the Philippines, all these other countries that, there's a lot of leveraging of, I would say, U.S. jobs to these countries in the form of cost control and that type of thing. So if we go to the next slide. So what I would say is your action points with respect to tariffs is let's monitor administration. Don't be too quick to react to, oh, he's going to issue a tariff. And I mean, the whole Mexico and Canada situation, he issued the statement and he said I'm going to have that by February 1st, right? And well, as part of that, he also didn't action a group to investigate how much the cost of that tariff would be to the country until like April 1st or something like that. So he's making a statement about February, but he hasn't even done the work yet, which is not until like April. So I think we got to make sure we read between the line and those types of things. But what I would do is seriously consider your alternative supplies. I would consider lead times. I would consider your inventory levels, your cash flow planning. Do you have enough cash flow to carry more inventory? That type of stuff. Again, not saying you need to act on those things currently, but I would definitely have those in your tool belt as far as figuring that out. All right. So then quickly, I'm going to hit on immigration. And I think the bigger thing for immigration is that I have 5 boxes here, and 2 of them already have been by executive order addressed by Trump. One is the birthright citizenship. Again, recognizing that the courts are going to get involved in this one as far as whether Trump had the right to even make that executive order, and then expansion of border and securities. That's also been done by an executive order. We also hear about the ICE raids, right? And the mass deportation or detention camps and so forth. These are things that are currently going on as well, right? So I think it's clear to say immigration is an issue, and it's going to get the attention it needs. And at what level does it start fizzling out a little bit? Is this kind of like, okay, I delivered on my promise, or does it carry into a longer duration of enforcement? So we'll see how those things play out. But next slide. So what I would do is I would predict that if the ICE raids start tailing off a little bit, and then the government still wants to enforce the immigration with respect to employers, there is the possibility of requiring everybody to do an eVerification for employment purposes. And it's probably more so for new hires than it is existing employees, but we'll see what happens on that. But eVerify is more so you submit the information to the government, they verify whether this individual is an appropriate from a hiring perspective, and give you that feedback. So I think that's one thing I see happening, and I think additional funding for border security, right, is one of those budget constraints where Eric talked about, well, will a tax bill get through or won't it get through, and that type of stuff. How much money is going to be needed for this border security is something that could play into some of the tax credits or deductions that we're looking for. So I think we're looking at those 2 types of things from an immigration perspective. So action items, again, let's watch and monitor the administration, but clearly this one's getting a lot of momentum on the front side. And we do see that cost of employees is likely to go up as a result of the population of workers that could be contributing to a business. So let's be mindful of that. Maybe build those costs, and I think Nancy will cover some of those uncertainties as she goes into her presentation. So that's what I have for what I call my 3 topics that I wanted to present to you. And I'll turn it over to Nancy so that she can work through some of the uncertainties and give you some thoughts there.
Thanks, Dan. So I'm sure by now everybody's heard a lot of information on this uncertainty. And so you've probably heard a theme throughout this, and I'm going to try to go through this really quick, and it's plan. We need to understand what's causing that uncertainty. We need to plan for it. We need to budget, and we need to make sure that we lead our teams and our businesses through these things. So really, we want to look at what's causing that uncertainty. And everything that you've heard until now is part of the reason that's causing so much uncertainty. We've had economic booms. We've had talk about recession. There's volatility in the interest rates and commodity pricing. There's natural disasters going on. Hopefully no more pandemics. We've gotten through that. But then there's regulatory changes that everybody has talked about, and there's so much uncertainty around those changes. So when we understand all these, now we have to look at, okay, what can we do? How can we plan for this? And so really what you want to do, first of all, is you want to evaluate your risk. And some of the things that Dan just talked about, these are some of the things that can cause risk in our organization. I'm sure everybody's heard of the butterfly effect. What happens, 1,000 miles away could affect us here. Some of these things might not be directly related to us, but they could still affect us. Something like immigration. Maybe you're not dealing with, immigrants, but maybe one of your suppliers is, and this may be a problem, and now you're dealt with higher wage costs. tariffs, this could cause your supply costs to go up. So I think it's important that you look at this and you understand what your risks are. You need to diversify. You need to diversify products, suppliers, customer base, and build a cash flow. Every business should have at least 6 months of operating expense as a cash reserve in case there's an event. You need to have that safety net. And then you want to look at your cost management. And this is something that businesses should be doing regularly. You need to make sure that all of your costs and your expenses are in line with what you expect, what you're budgeting for, and you need to be ready to eliminate any unnecessary expenses. I know it's easy to say, but I think this is very important if there's any uncertainty in your financials. You need to know what those numbers are and be able to react to them. Again, I talked about building supplier relationships. You need to make sure that you have a supplier on the bench, diversify your relationship with suppliers. So in the event that you can't get a product in time, that you have somebody else lined up. And then you need to invest in technology. I think this is really important right now. I actually have a slide on AI in here, but what technology can do is technology can analyze our data and help us respond quickly. So if we start to see shifts, technology can help us with that. You should be looking at data analytics. There's all kinds of systems out there that can help, that can create efficiencies in your business. I think that's really important right now. And I know we've heard so much about it, but I think this can really, really help businesses. And then we need to be creating budgets and forecasts. There's a difference between budgets and forecasts, and I think it's important that people understand. A budget is something you set before the year. It's kind of what you want to achieve. A forecast is what are you going to achieve based on any changes that's happening right now in your business. So you need to set a budget, you need to monitor that budget, and you need to understand what those variances are in the budget. Again, so you can react quickly to this. And hopefully at this point, you have a plan for how you're going to react to those issues. And so with a forecast, what you should be doing with forecasts is have multiple scenarios based on different assumptions. You need to have a best case scenario, worst case scenario, and you need to have a contingency plan. And Dan hit on this a little bit in his presentation, that you need to have plan B in case plan A is not going the way you want it to go. You need to make sure that you have that set. And here's some of the technologies that I briefly mentioned earlier. There's so much out there in AI right now that can really help. You've got Microsoft Copilot, Chat GPT, Power BI. All of these are tools that can help your business become more efficient. And we're really embracing this as an organization and helping clients. You know, we have a new program out there that can help with a 5-year budget, cash flow projection, making assumptions instantaneously. So I think this is really important that people start to look at this. And then I think the last thing that you need to do in your plan is communicate. Lead your business, lead your organization, and communicate to them. Make sure that employees understand. If you have a focus on embracing AI and technology, make sure that your employees understand that. Communicate to them. Let them know the decisions that the business is making. And then communicate to shareholders, communicate to your investors, suppliers. You need to constantly have that communication in the event something is happening in your business and you need to make changes. Make sure that people are communicated to. So I think this all boils down to being proactive, creating a plan, keeping people informed, and then more importantly, being agile in case you need to jump to that step B, that second case that Dan had mentioned earlier. So I know I went through this really quickly and I apologize, but I was trying to leave some room here because I see we have some questions coming in. So with that, I am going to turn it over to Lee for some questions.
Yes, Nancy, thank you. And Eric, Rick, Dan, Nancy, all of you guys, so much content. I just keep thinking about all the known knowns, the known unknowns, the unknown knowns that you guys were kind of covering. please send in questions you have. We do have a few minutes here set aside for Q&A. So let me jump into a couple questions that I've kind of aggregated, one of which, let me pull it up here. Eric, maybe you can cover a little bit of this. So we talked about some things you expect might happen, but can you talk a little bit about when tax legislation typically passes in a new administration? Like, do you expect that soon? Is that going to be a year down the road? And then when does it take effect typically?
Yeah, so we've got a couple examples from the last two major tax laws that passed. One was Clinton in 93 and the other was Trump in 2017. So Clinton was elected in 92 and passed, started operation as president in 93. And in August of 93, Clinton got his tax cuts through. And it was a really broad reform, but it included his tax cuts came through in 93. So that was into the fall. And if you go to 17, then when Trump was elected in 16, he started presidency in 17. By September of 17, when the Tax Cuts and Jobs Act took effect. So in each case, the president was elected with both the House and the Senate majorities, and it was by fall that they've got their when they implemented tax reform, they got their tax cuts, or in Clinton's case, some tax raises enacted. I think it's fair to say that that is a likely outcome now, that I'd be expecting late summer, fall to see that. The House has already said, some leaders in the House have already said, hey, by April, we're going to have a law, or we're going to have a tax law put together through the House here. That's fairly aggressive. So I think that's more talk than reality, because there's going to be some trading that goes on with the slim majority. But I still think this is likely to happen by fall. And if it doesn't, I don't know, maybe Trump dissolves Congress and does it himself. So we should see. Hey, that was good. Don't start the revolution. Just kidding.
We can look forward to that. No, so thank you. And any discussion then, I'm not sure if you addressed this, Eric, but when those laws then have they been grandfathered in? Have they taken place the following year?
Yeah, that's actually a good question, because it's been all three. There's been some that have been retroactive back to the first of the year. So Clinton was a good example. He did a tax increase and retroactive it from August of, when the law passed in August of 93, back to January 1st of 93. So it can be retroactive. It can be as of the date. There are things you see in the code, like when bonus depreciation went to 100% under the Tax Cuts and Jobs Act. That was 100% as of September 22. Well, why September 22? That's when the law passed. So it came into effect on the day the law passed. And then there's some that will be forward looking and saying, hey, starting next year, this is when it's going to happen. So that's up in the air. And to some extent, I think it'll be a function of how they need to tweak it and balance the budget and get it into their magical formulas, so that they can say that this is a revenue neutral bill, or whatever they want to do, is they'll move around those start dates. So that, I think, will come as late negotiation about when things end up getting implemented.
And Lee, I would probably add to that too, is, it could be also a mixed bag, as far as, like, they could say bonus depreciation is retroactive, right? But, the estate bill, that we're fine with that until 2026, right? So this thing could be dissected a couple different ways. Even if holistically the bill doesn't start until January 1st of 26, for a majority of it, some of the particular things could be retroactive, because that's what the business community might expect or want from Trump.
Okay, thank you. So you guys mentioned each, you talked about bonus depreciation. We had a question come in about bonus depreciation. So talking about for 2024, will it be 40%? Unsure on 2025, but do you think that could get back to 100?
I think it's going to be tough to go backwards to 24 the longer we wait. So that was a provision within that HR 7024 I had in my slide, is there could be bonus depreciation that goes back to 100%. When that stalled out in the Senate last year, that was the best chance to get it back to 100%. So that stalled. It did not happen. Now imagine if, if they can't get a tax law passed till August, September, which would be maybe a normal time. I think it's really difficult to say that they're gonna put in bonus depreciation at that time frame and walk it back to 2024. That's difficult. So I think it's more likely bonus depreciation for 24 is gonna be the 40%. I think it's 25 that could end up being 100. That seems more of a realistic possibility.
And Lee, I also want to kind of make a little correction. The 40% is actually for 25, right? And the
Was it 60?
60% is for 24. So just a date switch on us, but it's currently at 60% for 24. Still a big far cry from 100%, right? So.
Thanks, Dan. Yes. Okay. So we had another question come in about discussion around no tax on Social Security. What are you guys hearing there? Can you talk about that a little bit?
Yeah, that actually was, I think it was either in the campaign or right after the campaign, was no tax on our seniors. So lower tax on our seniors by getting rid of tax on Social Security. That could be another one of those provisions that comes up, kind of like no tax on overtime and no tax on tips that gets put in there. Each one of these provisions has a cost to it. And so that's how some of this gets put together, is they try to balance out all the costs with the income raises that are expected from some of this to, get somewhere near a balanced budget. They're not always successful at that, but that's the idea. And so the large cost items are ones that, sometimes can get pushed off the list. Social Security tax, no taxes on Social Security might be one of those larger cost items that gets pushed off the list, or they lower it down. Social Security has not always been taxed like it is now. Right now, it's taxed up to 85% of your Social Security. It used to be 50, and prior to 50, it was none. So it's not like they haven't lived without this tax before. I think it's still got a chance. It used to be out there.
I think I'd add, if you see it in a tax bill or a reconciliation bill, don't count on it passing, because that's how legislation works, right? The party in play is going to put everything on the table, and in negotiation, they throw the awkward stuff out. So if you don't put Social Security in, because it was a campaign pledge, then you're negotiating with a lower table. So, I expect I'd see it in and then quickly probably come out.
Okay. Well, like I said, I think my takeaway is there's a lot of unknown unknowns, known unknowns, all of the different ways you can say that. It sounds like you guys are going to be kept busy over the next however long, and we will do our best to keep everyone informed. But I want to be respectful of everyone's time. We're coming up on the end of the hour. So as we wrap up here, I just want to point out, you can go to svaaccountants.com to sign up for our tax alerts and our biz tips. And there's a lot of other resources there to help you. Our next scheduled webinar is March 11th, where UW-Madison Applied Economics professor, Dr. Stephen Deller, will again give us his Wisconsin economic outlook. Great presenter, really recommend getting signed up for that. And keep an eye out in your inbox for other webinar invitations from us, because if there are legislative issues that pop up, we will likely do more of these. And keep in mind, the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not currently an SVA client, please contact me or anyone in our business development group, and we can get you the help or the answers that you need. Thanks again to Eric, Rick, Dan, and Nancy, and to everyone attending today. Hope you have a great rest of your afternoon, and take care. Bye-bye.